The market feels a little contradictory right now, doesn't it? On one hand, the Federal Reserve keeps signaling that interest rates will stay high for longer than many want. That should be a headwind for riskier assets. But then you look at specific corners of the market, like crypto and certain strategic tech plays, and they're not just holding up, they're surging. This isn't just noise. It's a fascinating divergence driven by two powerful forces that are, for now, overriding traditional monetary policy signals. My read is that investors are pricing in a future shaped less by just rates and more by national ambition and potential policy shifts. We need to understand what those forces are and how they're pulling against the current. The first force is what I call the sovereign silicon race. This is the global competition among nations to dominate critical, next-generation technologies. Think artificial intelligence, advanced computing, space exploration, and robotics. Governments around the world, from the US to China, are seeing these sectors as strategic national interests, not just economic growth, but national security and future influence. This means massive capital is being directed into these areas, often through direct investment, subsidies, or favorable procurement. It creates a powerful tailwind for companies in these fields, driving valuations higher because the demand isn't just commercial, it's geopolitical. This capital flow is distinct from typical market cycles, making these assets less sensitive to interest rate hikes. The second powerful force is what some are calling the policy put, or more specifically, the Trump put, in today's environment. This isn't about politics directly, but about how markets are reacting to the prospect of significant policy shifts. For assets like cryptocurrencies, regulatory uncertainty has been a massive overhang. But recent commentary from former President Trump suggesting support for clear crypto legislation has sparked a noticeable rally. A put option typically protects against downside. In this context, a policy put suggests that the market is pricing in a potential shift towards more favorable, clearer regulatory landscapes, which acts as a protective floor or even a booster for assets that have been stifled by ambiguity. This potential for regulatory relief is a powerful catalyst, independent of the Fed's actions. So, how do these two forces interact with the hawkish Fed? It creates a bifurcated market. On one side, the Fed keeps pushing for higher for longer rates. This typically means a stronger dollar, higher borrowing costs, and generally less appetite for risk. It should cool down asset prices broadly. But the sovereign silicon race injects capital into strategic tech regardless of those rates, because national interest trumps short-term borrowing costs. And the policy put offers a counter-narrative for assets like crypto, suggesting that regulatory clarity will unlock new demand and capital, even if the cost of money is higher. This means that while traditional yield-sensitive sectors might still feel the squeeze, specific strategic tech and regulatory hopeful assets are demonstrating resilience, and sometimes even outright bullishness, against that macro backdrop. This divergence is more than just an interesting market quirk. It signals a fundamental shift in how market participants are weighing different signals. Historically, the Fed's stance on rates has been the dominant driver for risk assets. But now, we're seeing policy signals, both long-term strategic national policy and shorter-term regulatory relief, increasingly compete with, and in some cases, override those monetary policy signals. It tells me that a significant portion of capital is now prioritizing perceived long-term innovation themes and specific policy-driven catalysts over general economic tightening. This isn't just about a few niche assets. It reflects a broader change in investor psychology, where certain narratives are seen as powerful enough to defy the gravitational pull of higher rates. To navigate this complex environment, there are three key levers to watch. First, keep an eye on the Fed's commentary for any softening in their hawkish stance. If they signal a more dovish outlook, that could remove a major headwind for the broader market and potentially amplify the existing tailwinds. Second, for the policy put narrative, watch for concrete developments on crypto legislation. Specific bills, statements from key regulators, or political shifts will confirm whether this perceived regulatory relief is turning into reality. If it moves forward, the rally could sustain. If not, that tailwind could fade. Third, for the sovereign silicon race, monitor government investment announcements in AI, space, and advanced computing. Also, Track the performance of key companies in these sectors, especially their capital expenditure plans and how public markets are valuing their strategic growth drivers. Any slowdown in that strategic capital flow would be a signal. My bottom line is this: the market is no longer a monolith responding solely to interest rates. We're in an era where national strategic ambitions and the prospect of significant regulatory shifts are creating powerful, distinct currents. Understanding these forces, the sovereign silicon race and the policy put, is critical to making sense of where capital is flowing and why certain assets are defying expectations. It's a reminder that the world of finance is always evolving, and the drivers of value are becoming more diverse. For a deeper dive into these trends and my ongoing analysis, you can always find the full breakdown at korra.finance.